This is a Hot Pie Media original.
The contents of this podcast are for informational purposes only. You should not construe any such information or other material as legal, tax, investment, financial, or other advice.
Hi, everyone. I'm excited to welcome Ryan DeMattia today on our podcast. Ryan is the co-founder of Coindex Capital Management, which is an AI crypto hedge fund. And Ryan is going to share more about this amazing fund that he's managing, and Dexter, which is the proprietary trading algorithm that he's developed over the past years. So thank you so much for joining us.
Oh, absolutely. Thank you for having me. This is a great opportunity.
Thank you. Ryan, you've been publishing papers about crypto from 2011, ever since you were in college.
Yes. Yeah.
Back when Bitcoin was only worth about $2.
Yeah. Yeah. It's I like to joke that I didn't get in hard enough then. I was still just curious about it. I lost some Bitcoin on a laptop because, again, I didn't think they were worth much. But over the years since then, it's become more and more of a phenomenon, and I've paid more and more attention. And now I'm clearly all in. So
yeah, amazing. Can you take us through a quick rundown of the crypto history, how it emerged and how it has evolved over the past decade?
Yeah. So obviously, crypto history, we could do a whole podcast on just that. But a couple high notes. I think one of the first things to think about is that Bitcoin wasn't really the first idea of cryptocurrency. If you actually look at some of the white papers in the space and some of the original research, it goes all the way back to the late 70s and early 80s when people were just starting to conceive of okay, we have these computers. Is there a way to safely put currency in them somehow and store value and wealth in them? And there's a lot of different approaches to that and different academic approaches, but it was really the Bitcoin white paper, written anonymously or pseudonymously by Satoshi, and that could be one person, it could be a group of people. That kind of introduced this new wave that we're seeing right now, that is kind of like cryptocurrency actualized and not just theoretical white papers. The next big milestone that I think is really worth talking about is 2013 and 2014. Originally, Bitcoin was just this very operational and very technical thing to use. But by 2014, you'd really started to see the emergence of cryptocurrency exchanges where people could show up and buy crypto rather than having to mine it or interact directly with the blockchain to get it. And that really culminated with Mt. Gox, which was this centralized crypto exchange. In 2014, they were doing 70% of all the crypto volume in the world. And then they imploded because they were hacked and people siphoned what's now worth, billions of dollars worth of crypto. And so that led to this really important kind of hardening of the ecosystem where people realize we can't rely on just one place for all of this to happen. That's dangerous. That's not actually decentralized. And you saw the rise of all of these different exchanges and different things. I'm going to skip a few of kind of the intermediary years, but I think one of the next most interesting things to talk about was the rise of Ethereum and the Ethereum virtual machine and this idea of the smart contract, which really, I like to say that it makes good on the original promise of Bitcoin and the blockchain. The early days, there was a lot of people writing about what Bitcoin could turn into and how you could rebuild all of finance on the blockchain. And that's a very big, lofty idea. But what's really amazing about Ethereum and the smart contract architecture is that it paved the way for people to start doing that and start creating more complex systems on the blockchain. In my mind, it's like if Bitcoin was kind of this 0 to 1 moment where we put a ledger on the blockchain, Ethereum's kind of like 1 to infinity, where it's like, well, what else can we put on the blockchain? And so since then, you've seen this massive proliferation of new coins on the Ethereum blockchain. And then you've also started to see other new chains emerge kind of in that image. And that's kind of culminated to where we are now. And so market movements aside, obviously there have been bull markets and bear markets all along the way. But I think the important thing to look at is the infrastructure. And so what's really hot right now are both the spaces of DeFi and the spaces of NFTs. And both of those, again, are this Ethereum smart contract architecture being applied to really useful spaces and saying, how can we build more complex financial products using smart contracts? And how can we build intellectual property ownership using smart contracts? And so it's really interesting to see where we're at now, because 10 years later, I think you're really starting to see us realize some of the original ideas of what crypto could turn into when it was just $2 and, the market cap was tiny and you needed to mine it to get your hands on it.
Wow, fascinating. And DeFi, which we hear a lot about these days, is only about a year and a half old industry, right? Yeah.
It's again like Bitcoin. It had this long runway where nobody knew about it, and it grew very slowly. And then, just like Bitcoin, it hit this inflection point where it just exploded. And that time period was really about a year or so ago, where I think Uniswap was one of the first big ones, along with Curve and Compound, which quickly captured a lot of capital value in their smart contracts. And it's because they offered some really useful financial products and services that hadn't existed before. And those are things like decentralized borrowing and lending. And so this kind of points at like what DeFi is really doing and what it's accomplishing, which is taking traditional financial services and products and bringing them onto the blockchain, and then taking that a step further and saying, what innovations are possible using this blockchain? Now, what are the things that we can do here that we couldn't do in traditional finance for one reason or another?
Mm-hmm. That's really, really interesting. So can you speak a little bit about NFT too? So, because I know it's a lot, like before we had a podcast about blockchain investing, now we're about crypto, and then we have DeFi and NFT. And could you speak?
Yeah, absolutely. So NFTs aren't something that, like, as a firm we're engaged with, but it's something that I'm obviously very interested in, just being as close to the space I am. Fundamentally, I think, so first of all, I think there's a ton of froth in NFTs right now. Just like the art market, they kind of are going to represent the larger market trends. And so that's why you're seeing DeFi art sell for, hundreds of thousands and even millions of dollars. I think kind of the burning question there is like, what's the staying power of value for new art versus old art? And again, like, that's a really interesting conversation we could have a whole other podcast about. But I think NFTs, if you had to sum it up, they're doing something really interesting in the spaces where they're actually solving real problems around intellectual property ownership. And so for like small content creators and niche content creators, they're supported by communities. Those are creators who have typically not had very effective means of commercializing whatever it is they're producing. Or they have to work with an intermediary like Spotify that takes a pretty egregious cut out of any community sourced income that they could get. So for those creators, NFTs represent this way of kind of unlocking the capital potential of their audiences to support their art. And then there's this larger idea of NFTs where it's like, what could these things become? Because if we're talking about intellectual property, it doesn't just end with, art. That's a great place to start. But I think where you could go with that is into things like patent law and actual copyright management and copyright infringement management, using the blockchain and kind of using this totally transparent smart contract system where you can see who really created what and who really is owed royalties to intellectual property work and contributions.
Oh, that's great for the users.
Yeah.
So as of recently, more and more traditional financial institutions such as big banks, institutional investors adapt to this to our new digital currency era by forming special trading desks and allocating capital in the space.
Sure, yeah.
How, in your opinion, Wall Street is affecting this rapid market growth? And are we the new Wall Street of crypto?
Yeah, that's a great question. I think there's a couple things. I think Wall Street now fully recognizes the earning and capital potential of crypto. I think some of the smartest players were recognizing that in 2017, and you saw some of those early trading desks emerge back then. And they've probably done very well now that they're 4 years into that. And you're seeing other folks kind of start to take exposure now when it's starting to seem a little bit more mainstream. But I still think it's really early. I think ultimately, though, Wall Street's going to be a participant in crypto. And I think what's going on is it's not like creating the new Wall Street. It's almost creating something completely different, right? Just like Silicon Valley didn't recreate Wall Street for tech, it kind of created this whole new capital ecosystem around tech that was its own kind of animal and its own unique thing. And so I think crypto is ultimately going to do the same thing. And it almost sits at the middle because crypto is more finance than Silicon Valley, but it's more tech than Wall Street. And so it's almost this new middle ground between the two that could become a third kind of universe.
All different new animals.
Oh yeah, definitely.
Cool. So 5 years ago, you developed Dexter, a proprietary crypto trading algorithm. Tell us more about how you came up with this AI and what makes Dexter such a successful algorithm in predicting market movements.
Yeah, so that's a great question. So it all goes back to my personal trading experience with crypto. So when I first started trading crypto, initially it was pretty casually spot asset trading and trading on relatively longer time periods, days to weeks. And it wasn't that active. It wasn't that involved. But as I started getting more into crypto, everything just kind of accelerated. I started trading on smaller time frames. And I was amazed that the further down you looked, the more granular everything got. The data was so rich. The other problem there was that these markets ran 24/7, 365, and I just simply couldn't keep up at all. So I started just by trying to write kind of like a simple silver bullet algorithm, one set of rules that would fit any situation and make money no matter what the market did. And the problem with that is, fundamentally, it ignores one very important factor about the markets, and that's the fact that they're always going to keep changing no matter what. And so there's never going to be a single silver bullet that will apply indefinitely into the future forever. And that was kind of a light bulb moment to realize that okay, the one thing I really need to control for here is the fact that the markets are always changing. So what we realized that we needed was a piece of technology that itself would always be changing and adapting to the market. And so by doing that, we don't have one single idea of what the perfect model is, because the reality is it's always changing. And the model tomorrow might not be the model today. And so by keeping Dexter kind of flexible and adaptive, he can continue to be ready for the market tomorrow rather than the market today. And then in terms of, it's interesting, in terms of predicting the market, I think what's really unique about Dexter is less that and more how he actually manages the process. Because I think a lot of traders can look at the market and they can look at charts and get a pretty decent inclination of where the market might go next. And so they take a trade. And then where a lot of traders go wrong is everything that happens after that. Deciding when to close a trade, deciding if they should stop out at a loss, if they should exit at a profit, how much profit is enough. And all of those things unavoidably bring in tons of emotions, especially as you make gains or losses. And that's where Dexter really shines. Because what Dexter can do that we cannot do is remove emotion from the process altogether. And so what that means is that if Dexter knows something is statistically more likely, option A is statistically more likely than option B, regardless of what the market might look like in this moment, he doesn't have any uncertainty about taking that decision the way a human trader does. On top of that, the 24/7, 365 thing is really helpful. So it kind of becomes this John Henry game of man versus machine, where humans can be good traders and they can make great trades, but what a lot of humans struggle with is consistency and discipline in trading. And software is amazing at both of those things. And then also humans get tired, and one day they might be in a different emotional state than another. And Dexter's just a computer. He runs the same every day. Doesn't matter if it's hot or cold, rainy or sunny. He's got the same attitude. And so that's what really makes Dexter unique, I think, is his ability to remove the human elements while still incorporating some of the things about a human mind, like its ability to learn and adapt, that are really useful for the markets. That's where it's like he's modeled a little bit more like a person and less like a robot.
Mm-hmm. We love Dexter.
Oh yeah, I mean, I sleep easy now thanks to Dexter.
Great. And tell us how your fund, Coindex Capital Management, is achieving its goal of risk-adjusted returns in the face of really extreme volatility.
Yeah, that's a great question. I can't go too much into detail about the funds, unfortunately, just with the nature of them, and kind of the investment requirement around public solicitation. But I can say that most of the crypto market is showing up to speculate, right? And so usually that means they're trying to buy an asset and hope that it goes up, or sell an asset and hope that it goes down so they can buy it at a lower price later. And then you're starting to see people speculate on top of that, like taking leverage on top of those positions and essentially magnifying their gains and losses. And so anytime most of the people in a market are doing one thing, it creates this opportunity where a few people can do the other thing and essentially get this asymmetric return or this asymmetric opportunity. So at Coindex, what we focus on is, instead of trying to speculate on where price is going to go, and instead of getting caught up in all of that excitement and energy, we try to focus on how we can generate returns that are consistent. Because at the end of the day, we think that that's one of the things that is in rarer supply, essentially, in the landscape. So we use a few different strategies, but again, it's focused on neutralizing the risk and kind of getting anti-fragile to that risk rather than not considering it. Because again, like the one thing you can count on is that the markets are volatile. So if we design our fund such that we make money off the volatility rather than off of the actual direction of any given token, that helps us be in a position where we don't care too much about whether the market's going up, down, or sideways.
Right, that's great. Yeah, because crypto can really go down so much, but with Dexter, you guys are so lucky to not be losing money.
Yeah, extremely grateful to have the technology, because again, it makes years like 2021 a lot easier to navigate. Earlier this year, it's like it was very easy to be bullish on crypto when everyone was making double-digit returns like week over week as Bitcoin was printing new high after new high. But like I said, having been in the space since 2011, I remember what typically comes after that. And what happened after we hit 20,000 in December of 2017 was the bear market of 2018. Brutal losses, 90% drawdowns across the sector. And again, like that's the thing that you have to keep in mind, I think, as a crypto investor, is that it cuts both ways. The volatility has this great upside that can be a great earning potential, but it can very quickly turn on you. And because there's no fundamental underlying thing to this asset, it's not like equities where there's like a company and earnings behind it. It's very technical and it's very mimetic, which means traders see what happens to the price, and it reinforces perceptions about the asset, and it creates this feedback loop. So you see these fear and greed cycles, where everyone gets really bullish and they get really greedy and they're like, oh, it's going to go to 100K. And then suddenly that turns around, right? And suddenly people are like, is Bitcoin going to go back down to 10K? And you see these cycles kind of ebb and flow continuously, I think.
Fear and greed cycles.
Yeah. And you see it in a lot of markets, but again, crypto especially, because all people have to look at really are the charts and then like what people are saying on Twitter, right? And that's why like Elon Musk,
what one person is saying on Twitter.
Right, exactly. And so like there's nobody to step in and kind of ease people's minds like the Fed with the dollar, or like board meetings with shareholders the way you have in equities. It's all perception. And so there's that feedback loop about what people think about it and then what they say.
Wow, enormous market manipulation.
Yeah. It's still the Wild West in that regard, where it's like everything influences price because there's no one true bearing for like what a Bitcoin should be worth, right? There's a lot of ideas about how you should price it, but there's no one kind of true measure of its value.
Yeah. Well, I can continue chatting with you about this topic for hours and days and weeks, but we are coming towards the end of the interview, and I will finish up with our final question for this episode. What, in your opinion, is the future of digital assets, and what is your advice for the retail investors who want to get into the game of crypto investing?
Yeah, that's a great question. So technically, I can't give advice for retail investors, but some things I can say and recommendations that I can make is just think more about risk than about opportunity, because I think that's where a lot of people make mistakes, is they focus more on gaining rather than on capital preservation. And so there are strategies, like classic investment strategies, that can be a little bit less risky. One of the ones that I love that like Dan Held, who's a massive Bitcoin bull, loves to talk about is the dollar cash average, where it's like rather than trying to guess the right time to buy Bitcoin, if you think it's going to go up in the long run, buy a little bit every week. And he put this chart together that's like, if you bought, I think like 10 or like $50 worth of Bitcoin every week for the last 5 years, you would have spent something like 30 grand and it'd be worth like 500 grand. Mm-hmm. And so my recommendation to anyone looking to get into the space is just tread lightly and don't put all of your eggs in one basket, because I think the one thing we can say about digital assets is that analogy to the markets. They're always going to keep changing. We're not going to know if NFTs is going to be the hottest thing next year, or if it's going to be DeFi, or if it's going to be something totally different. Mm-hmm. And so by thinking broadly about the space and not moving too impulsively into any one thing, you can continue to survive another day and, take another action the next day. And that can help you make it in the long run and not get shaken out like a lot of people did between 2017 and 2020, during that whole kind of low period where Bitcoin traded all the way down to like 3K.
Mm-hmm. This is great advice. Thank you so much, Ryan DeMattia. It was such a pleasure.
Yeah, no, thank you, Ash. Anytime. Happy to come back on. It was great as always.
Thank you. Hopefully we'll see you soon and continue the conversation.
Yeah. Thank you guys for tuning in.
Bye, everyone.
Thanks for listening. You can find more episodes and all of our other Hot Pie Media originals baked fresh daily at our home online at hotpiemedia.com, the Hot Pie Media YouTube channel, or wherever you listen to podcasts.